If an ETF can deliver growing cash flow for more than a decade, through COVID, through inflation, and through multiple market sell-offs, that ETF deserves serious attention. That is exactly what Schwab U.S. Dividend Equity ETF, or SCHD, has done. Most investors focus on price charts and short-term returns. But for income-focused ETFs, that approach often misses what really matters. SCHD's real strength is not volatility or momentum. It is the ability to generate reliable and growing cash flow year after year, even when markets struggle. This is Dollar X Dollar, a channel dedicated to deep, data-backed ETF research for long-term investors focused on building financial independence. In this video, we will break down how SCHD is built, why its dividends kept growing through periods like COVID and high inflation, and what makes its income behavior fundamentally different from most ETFs. This video is for educational purposes only and does not constitute financial advice. Without further ado, let's get started. Schwab U.S. Dividend Equity ETF, or SCHD, is a low-cost U.S. dividend ETF designed for investors who prioritize income quality, dividend growth, and long-term stability, rather than short-term price movements. It tracks the Dow Jones U.S. Dividend 100 Index, which uses a strict rules-based selection process. To qualify, companies must have at least 10 consecutive years of dividend payments, meet size and liquidity requirements, and rank highly on dividend sustainability rather than yield alone. Final selection is based on a composite score that equally weighs cash flow strength relative to debt, profitability, dividend yield, and 5-year dividend growth. The index holds roughly 100 companies, and any company that cuts or suspends its dividend can be removed immediately. The portfolio is overwhelmingly large cap. Roughly 58% is invested in companies with market capitalizations above $70 billion, with most of the remainder in large established firms. Exposure to small and micro caps is minimal, which naturally reduces speculative risk. Sector exposure reflects where dividends actually come from. Energy, consumer staples, healthcare, industrials, and financials make up the core of the portfolio. Technology is included, but at a much lower weight than growth-focused ETFs, meaning SCHD is not dependent on tech cycles to deliver results. The top holdings reinforce this design. The portfolio is made up of energy majors, defense contractors, pharmaceutical companies, telecom operators, and infrastructure businesses. No single stock dominates the fund, and concentration risk is kept under control. With an expense ratio of just 0.06% and a focused portfolio of around 100 holdings, SCHD is built to deliver reliable income that can grow over time, even when markets are volatile. One of the main reasons investors hold Schwab U.S. Dividend Equity ETF is its ability to deliver a consistently high and reliable dividend yield over time. Over the past decade, SCHD's average dividend yield has typically ranged between about 2.7% and 3.8%, remaining well above the broader U.S. equity market across different interest rate and market cycles. Even during periods of volatility, the yield has stayed stable rather than collapsing or disappearing. Reliability is the key. SCHD's income does not depend on a small number of stocks or short-term price movements. Dividends are supported by a diversified portfolio of large, profitable companies that generate steady cash flow. This reliability is best seen through yield on cost. Yield on cost measures the dividend income earned today relative to the original purchase price. As dividends increase over time, yield on cost rises even if the market price moves sideways. For SCHD, yield on cost shows a clear long-term uptrend. If you bought one share back in October 2011, the yield based on the most recent dividend payment is about 12.37%. That means the same original investment is now generating more than 12% in annual income. This combination of a competitive starting yield and a steadily rising income stream is what makes SCHD suitable as a core income holding rather than a short-term dividend trade. When investors talk about performance, most people focus on price and capital gains. What often gets ignored is the strength and consistency of the dividend itself. For Schwab U.S. Dividend Equity ETF, dividend growth is the real engine of long-term returns. Over the long term, SCHD's dividend growth has been exceptional. Excluding 2011 since it was not a full year, the dividend has compounded at roughly 10% to 11% per year through 2025. That level of growth is rare for a diversified dividend ETF and rivals many growth strategies, but with far lower volatility. The annual dividend payment increased from about 27 cents in 2012 to more than $1 in 2025. This growth did not rely on valuation expansion or market timing. It was driven by the underlying cash flow and profitability of the companies in the portfolio. What many investors overlook is how SCHD behaves during stress. In 2020, during the COVID shock, SCHD still increased its dividend payment. In 2022, when tech and growth stocks experienced major drawdowns, SCHD again delivered dividend growth of nearly 14%. Most importantly, year-over-year dividend growth has always remained positive. The dividend has never stopped growing and has never gone backwards. This is the strength most people miss. Prices can fall, stall, or move sideways for years, but SCHD keeps increasing the cash paid to investors. Over time, this creates a form of perpetual income growth. Cash flow rises year after year, yield on cost increases, and income compounds quietly in the background. For SCHD investors, progress is not always visible on a price chart. It shows up as a steadily rising stream of cash across both good markets and bad. A lot of investors look at dividends and focus on yield or payout ratios. What actually matters is whether a business can consistently generate cash. That is why cash from operations is so important. When you look at the top holdings inside Schwab U.S. Dividend Equity ETF, a clear pattern emerges. These are not companies stretching to pay dividends. They are businesses generating large and repeatable operating cash flow year after year. Take Verizon Communications. It produces close to $38 billion in annual cash from operations, supported by subscription-based revenue that remains stable even during economic slowdowns. This kind of recurring cash flow is ideal for sustaining long-term dividends. Chevron generates more than $30 billion in operating cash flow. Even through commodity cycles, it produces enough cash to fund dividends, capital investment, and balance sheet strength at the same time. In consumer-facing businesses, Home Depot consistently delivers around $17 billion in operating cash flow, driven by scale, pricing power, and everyday demand. That cash generation supports both dividend growth and resilience during slower periods. Healthcare names such as Merck and Bristol-Myers Squibb each generate well over $16 billion in operating cash flow, providing stability regardless of economic cycles. Even industrial and technology holdings like Cisco Systems, Texas Instruments, and Lockheed Martin generate billions of dollars in recurring operating cash every year. These are not speculative businesses. They are cash-generating machines. This is why SCHD behaves differently from many dividend ETFs. When market prices fall or move sideways, these companies continue to generate cash. That cash funds dividends, supports dividend increases, and provides resilience during downturns. This is exactly why SCHD dividends increased in 2020 and again in 2022. The market struggled, but the cash flow engine never stopped. When an ETF is built on businesses with strong and repeatable operating cash flow, income does not depend on market sentiment. It becomes perpetual, driven by real economic activity rather than price movements. That is the foundation behind SCHD's ability to deliver reliable and growing cash flow across full market cycles. Schwab U.S. Dividend Equity ETF is built for investors who think in terms of years and decades, not quarters. It suits investors who value growing cash flow more than short-term price movements, who understand that income backed by real business performance compounds quietly over time. It works well for those building long-term portfolios, planning future income, or simply wanting an asset that continues to do its job regardless of market headlines. SCHD is not designed to be exciting. It is designed to be dependable. While prices move up and down, the underlying businesses keep generating cash, and that cash keeps flowing back to investors in the form of dividends. Over time, that behavior matters more than short-term outperformance. It is what allows income to grow, yield on cost to rise, and portfolios to become more resilient as markets change. If you found this breakdown useful, consider subscribing for more research-driven ETF analysis. In the next videos, other than SCHD, I will explore more ETFs designed to generate reliable and growing cash flow and show how they can fit into a long-term portfolio framework. That is where the bigger picture starts to come together. Thanks for your time today. I will see you in the next one.